Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Joining us today is Tavi Costa, partner and portfolio manager at Crescat Capital. Great to see you, Tavi.
Thanks for having me. Looking forward to this.
Yeah, absolutely. And it's such an insane time in the economy, Tavi. The Fed keeps raising rates. There's a lot of debt and issues piled up into the economy. Rates, like how can Fed and the Powell continue to raise rates without breaking more in the markets? And how will this affect silver and gold?
Well, I've been in the sort of in the camp where I think precious metals and mostly gold specifically will serve as a haven asset relative to other crashes that we've had in the past, like '08, for instance. A lot of people like to look back in that period. But I think it's going to play out similar to how we saw back in the early 2000s and also in the 70s when gold actually served as a defensive asset that appreciated during times of turmoil. And I think it's proving to be the case here as well. Gold has been performing better than equity markets for a while now, and I think we'll continue to do so. One of the things that we looked at back in November, if you remember, was the percentage of yield curve inversions that reached over 70% back then. And every time we've hit that level, the gold to S&P 500 ratio tends to rise significantly. And there are times when the gold price actually falls, but equity markets fall even further. And this time seems to me that both legs of this trade could actually start working. So I'm very optimistic about this part of the market. I think there's opportunities not only in gold itself. I think there's a reason why gold is the only asset in the planet today. And I'm talking about a macro asset that is making new highs. It's not the S&P 500. It's not NASDAQ. It's not Bitcoin. And it's important to know why that is happening. It's because of the issues that we're seeing unfolding, and gold is sniffing around that we're going to need more liquidity at some point, and that's going to drive the metal much higher.
Absolutely. Do you have a price target for gold for the end of 2023? A lot of people that we had on recently said it's not out of the question for $2,800 gold for the end of the year. So what do you think?
Well, I don't have a price target necessarily for the end of the year. I don't approach markets like that. I
Right.
wouldn't be surprised if we see, 2,500 by the end of the year. I think that's plausible. If I see more than that, great. And if I see a little less than that, I'm also very happy. I think
Right.
ultimately, if we see things firming up, which they are, and they seem to be firming up very fast in terms of breakouts and so forth in different parts of the precious metals market. It's hard to believe that that's not going to be fitting or really filling this whole mining cycle that we haven't had yet. We've seen some parts of that market improve, but I think there's a lot more of that. Again, it's the first time I've seen gold making record levels, and the majority of the mining stocks are still at very depressed valuations. To me, it's a very important opportunity that I'm paying very close attention to.
Absolutely. Oh, and we talked a little bit before the interview about the debt ceiling and all the issues it can have in the market. That's a huge talk right now. What's happening with the debt ceiling and how can it affect even precious metals or the other markets?
I think majority of the focus on the debt ceiling has been specifically on the default risk, and I think it's something to be concerned about. But I don't think that's really the problem here. I think the problem is after the two parties, which ultimately will agree on something, because they have no option, so they're going to
Right.
have to, even if there's some showdown of disagreements for a while, and we may see even in a technical default. I still think ultimately they're going to have to agree on something, and once they do, the real issue is how will the market absorb all these issuances of treasuries that they have to do in order to catch up with something they haven't done in the last months or so. And I think this is sort of at the core of everything, because if you have another flood of issuances of treasuries, that could eventually cause treasury prices to fall, given the excess of supply. Everything is tied to that as a collateral. I mean, this is the whole reason why the banking industry had issues, was because of the losses in those holdings. And so what does that do if treasury markets decline another 50% from where they are currently? With the market, how would the market really behave in those conditions? And I'm really concerned about those things, because I think I think that most of the equity markets, particularly the mega cap part of it, continues to show fundamental issues in terms of their businesses. You're not seeing growth whatsoever in most of those companies.
Right.
And their valuations remain at levels like we're going to see another 10 years of low cost of capital and high growth, which I think it's highly unlikely. So those are all the things that are really involved with the debt ceiling, but really the post-agreement phase where they have to issue all those treasuries.
You brought up a great point of treasuries. What happened if they could drop another 50% just now? What type of chaos would that cause?
Well, I think there's a lot of things that could be tied to that. And I didn't even say 50. I just said 15.
Oh,
Sorry, my accent is a problem here.
no
But
worries.
I think a 15% decline is already, well, it
Right,
could fall for 50. I'm not saying you couldn't, but I'm not calling for that. I think that would be extreme.
right.
I do think, real estate is tied to that. Well, think about private equity companies that are now running already losses in most of their balance sheets. They're completely mismarked because they own a bunch of technology companies. They're supposed to be marked much lower, especially tech startup companies, and they haven't done that yet. And so, how would they look moving forward if we don't see? Again, everything is tied to that rate environment. If what we've seen so far of this what I think it's a bear market rally has been mostly fed by this move or decline of financial conditions that actually eased up a little bit recently, along
Hmm.
with interest rates and the 10-year in particular, not the Fed funds rate, has actually declined year to date. And so, I think there's a lesson. If you just look at the European banks, for instance, we're not seeing the same level of strength of the treasury market in the last months relative to what you see in foreign bonds.
Right.
And most of that is because they continue to issue those bonds. The treasury market has just not issued any bonds because of the debt ceiling. So, I think that's a real problem that is yet to become on the news, and not so much the debt ceiling itself, but the issuances of those treasuries.
Absolutely. And I have to ask you, Tavi, we are Wall Street Silver, so we need to know your thoughts on silver. Here is one of your recent tweets on silver. I'll bring it up right away. Silver is about $25 per ounce. What do you think is driving the price of silver?
Well, I think it starts with gold. We're seeing central banks beginning to report more and more that they're buying gold. I've shown the chart of the purchases of that happening, but really the idea is if gold relative to international reserves is sub 20%. Historically, that should be at about 40%. So if we see just a move back to the historical mean, which in the 70s used to be 70%, but just going back to the 40% handle, I think it would just the math would be about $2.5 trillion of influx of capital just to the gold market itself. That I think the 60-40 portfolios and other places that have been showing a lot of pressure from investors for improving their own portfolio allocations and have some more gold and other assets that are, in my view, tangible assets and things that will be in demand for most of those institutions, along with central banks. And, those things are changing. And so the influx of capital from central banks is what starts. And now we're seeing gold beginning to be, I guess it's the only thing in all-time highs today. And so, that narrative needs to change. I think people are very skeptical about those metals. And silver, to me, when gold is in its cycle, boy, if this is the beginning of a cycle for gold, silver is absurdly cheap right now. It is probably, as I've said before, the cheapest metal on earth.
Hmm.
But it's, in my view, if you think that way, imagine owning deposits of silver. They're still in the ground. So, which means the leverage to the silver price is absolutely insane. And so, I think that's really the generational wealth possibility or opportunity really is in this part of the market. So I'm really excited about that because I feel like the macro and fundamental case has never been stronger, and we're seeing things, a lot of things materializing in our favor. So that's where we've been deploying capital recently.
Yeah, it's very exciting times in the precious metals market. And I read a article recently. It said that they're thinking about a $1 trillion platinum coin that would save the U.S. From economic catastrophe. Why can't they rationally just discuss budget cuts to get things under control instead of just bringing up a $1 trillion platinum
Hmm.
coin?
Well, I think there's a reason for that. Well, if you think about just the size of the agenda today with military spending, I mean, back in the days, it used to be 9% of GDP. Today,
Right.
it's less than 3%. So that's on the rise. That's probably going to go back to levels that we've seen historically, which are much higher than today, at least double than where it is today. Think about the Green Revolution as well, or just the manufacturing spending that we're seeing in order to reduce reliance with China and the
Hmm.
social programs because of the inequality problems that we're facing. And now you throw another problem into this, which is the actual debt payment of this. The interest expense is now 50% of the fiscal deficit relative to GDP. And I think it could be even more than that in the next months. And so, it is a problem. And I'm not sure it can really be reversed. So the alternative for investors is to really jump away from those assets that are linked to those things, and mostly treasuries and other fixed income assets. I mean, you were talking about the issues we have in the markets. How in the world is VIX, the volatility in equity markets, is still at the levels that they are currently?
Yeah, it's crazy.
Or credit spreads. Think about corporate bonds that tend to blow out in recessions, and we haven't seen that yet. They're very suppressed. So
Right.
you're a short seller. There are many opportunities here, and we've been trying to take advantage of those.
Absolutely. As the U.S. Dollar erodes over time, how critical is it for everyone to already be in precious metals? Will it be too late for a lot of people once, stuff really hits the fan?
Late, you mean? I'm not sure it's late. I think this is, well, usually gold cycles take a long time to play
Right.
out. So, I would think that this could be a 10-year cycle, easily. And if that's the case, especially because the prior cycles, I don't think we had the same degree and magnitude of imbalances we have today. In the 70s, we had inflation, but we didn't have the debt problem. In the early 2000s, we had a valuation problem similar to today, but we didn't have the inflation problem. And today we have inflation, debt, and valuation all together. And
Right.
so it's just hard to believe that those are not going to become real political constraints to not only resort back to financial repression over time, but also allow investors to reallocate their portfolios over time into gold, as gold sort of reestablishes this credibility of being a haven asset. I think has lost that credibility recently. And it's funny that investors want a lot. If you ask a millennial if you would take the same amount of gold versus Bitcoin, they would take Bitcoin over gold.
It's crazy.
And to me, that's absolutely insane.
Yeah.
But I I'm not bashing on Bitcoin itself. I just think it's a speculative asset. We've seen that speculative wave in the last 10 years, and probably not going to see another one here in the next 10 years. So, things have just changed accordingly. So,
Why do you think there's a huge you just brought up like kind of like the youth, and why do you think a lot of them are cut off and they're more focused on NFTs and Bitcoin and digital assets that make quick money instead of a proven asset like gold or silver? Like why do you think they're cut off?
I would say an unpopular opinion here. I think that by the end of this cycle, we're going to see, especially the younger generations, the millennials, actually hate crypto at some point. And
Right.
it's going to be, probably the time to be buying some of those assets. But why? Well, I think it has to do with the fact that we've had cheap money policies and we borrow most of the returns from the future to the present. And you talk to most young investors, their expectations in terms of returns of assets is insane. A 10% increase in prices is not enough.
Right.
And yes, I mean we've had a period where most of those assets, especially in the crypto space, had incredible returns. But things don't grow to the like that forever. We're going to see an end to those things, and especially when you have cost of capital beginning to rise, and will start impacting the way we discount assets in general, the way we value assets. And so things are about to change significantly. So, risk management is something we haven't really talked about. I mean, this whole generation hasn't really learned about that at all. And so,
Right.
sometimes I guess we got to take the hard lesson, and I think we're about to see one.
A lot of people are comparing now to 2008, or is it more similar to now to like the Great Depression in 1920s and 30s? What are you comparing it to?
You should be looking back in history and trying to see what are the similarities. The
Hmm.
similarities with '08. Look, I think the problem here back in those days, the problem was the debt issue was mostly in corporations and households. Today, the issue is with the government. So it's a little bit different in that sense. The banking problems are, something that I don't think a lot of people say it that they saw it coming, but none of them are short the banks, right?
Right.
They're all short after the SVB and all short after the problems happen. And so, that is the definition of a black swan event, is when
Right.
no one is positioned, not talking about it, but positioned to profit on that. And, I think that the similarities with the 1920s is quite interesting, because back in those days, this was the beginning. The same way we're seeing a lot of the younger generations entering the market, which they tend to value things completely different than older folks and or
Right.
people that are a little more that've been in the market for a long time. And a similarity with this is back in the early 2000s or 20s or mid 20s, we saw the introduction of women starting to invest in the stock market, and that was a very interesting era where there were some companies that were benefiting from those trends. And it created sort of a speculative environment, and this is not
Interesting.
a yeah, it's nothing. I'm not trying to be a sexist or anything like that. I'm just making a point of history
Right.
of times when you have different folks entering the market or maybe generations, or in that case was it kind of filled this speculative environment that was already in place. And it's similar to today, but in the sense of a generational era of folks entering markets like we've never seen before. The younger generations are certainly more allocated towards financial assets, than we've seen recently, and
Right.
so or other decades. And so, that has an impact on how things are valued. Remember the GameStops and other stocks that actually benefited recently, and now are back to either bankrupt or having problems. And so, at some point, the market goes back to sanity and goes back to reality. And we've been in La La Land for too long, and probably going to be a little bit problematic for the next years. But that's not the end of the world. It just changes how you allocate capital.
Absolutely. And with all the chaos in the market going on right now, what are you keeping an eye on right now in the silver markets? Junior miners, producers, what are you looking at?
Well, as you know, we've been very focused especially in the most inefficient parts of the market, which I think are an exploration in the development phase of the industry, not so much the producers. The producers are the ones holding aging assets. They're not really investing in production growth. And that is setting the stage for other people to create the new Newmonts and Barricks of this cycle. And so I've been focusing in early stage companies. One of them is Eloro Resources in Bolivia. We actually have a very different view of a lot of people in terms of the political environment in Bolivia. We think everything has a price to begin with, but
Right.
also the level of opportunity that we're seeing there in terms of the size of the deposit with Eloro, for instance, and the opportunity in terms of the potential profitability of such deposit over time as well, when it comes to become a producing asset and so forth, is defining. We're at the defining stage of that resource right now, but continues to show a lot of a lot of good things so far. We're happy shareholders of the company. We've been investors since the early stages of it, and look forward to continue to be investors over time as well. But I think there's a lot of other opportunities in other parts of the world, not just that. I like South America a lot, like Brazil, I like Bolivia, I like some parts of Peru. But also we like to have assets in Canada, in the US, in other parts that are perceived as safe jurisdictions, but also have a lot of issues when it comes to developing those assets. So yeah, those are look, it's one of the few places or companies, Allura Resources, that have exposure not only to silver but tin, which it's an interesting exposure that it's just difficult to find deposits that are economically viable
Right.
that have exposure to that as well. And so according to Quintin Henney, it really resembles the San Cristobal project itself in Bolivia as well. And so we're really happy to see the development of that story, and think will continue to be a very interesting investment for us. And we're very glad to be shareholders of it.
Well, it's a huge pleasure having you come down to Wall Street Silver and share a lot of your knowledge here. So thank you so much, Tavi, and hopefully we can have you back on in the next 2, 3 months.
Sounds great. Thanks for having me again.
Awesome. Talk to you soon.